I could give you almost any rate that you wanted. It's bait and switch tactics. There's companies out there that are making 400 basis points. Just lost all that money.
Yeah.
It stands for debt service coverage ratio, but we're not looking at your income. We're not looking at your employment.
People would buy a house and then literally sell it a week later at a profit.
Higher rates are a buyer's best friend. The feeling of helping someone that never thought that they could buy a house, that chokes me up.
What's up, guys? My name is Shaun Surgener, and I am sitting here with the CEO and founder of Lending Hand Mortgage, the #1 lender and broker in the entire state of Tennessee. I've actually worked with Kevin personally on multiple deals. He's super fast, transparent, and simply one of the best in the business. And today we are going to be exposing real lender secrets that buyers and investors never hear. Hidden fees, lender traps, how to qualify for the best rates, DSCR loans, and what is happening in the markets right now. Before we jump in, there are 3 things that lenders do every single day that cost buyers and investors thousands. And today, Kevin is going to break down every single one of those. So I'm super pumped to chat with you, Kevin.
Likewise, Shaun.
Let's do it.
Yeah.
What is one lender trick that people should watch out for immediately?
When someone comes to me and they say, I want a certain rate because someone else is offering it, then I get real transparent. I say, let's see what their fee sheet looks like. Let's see what their loan estimate looks like, because I could give you almost any rate that you wanted, but there's some costs that come.
Right.
There's some association of costs with that interest rate. So the one thing that you want to make sure that what is the break even of that interest rate? Yeah, you can buy down your interest rate, but interest rates also go in cycles. So I think the biggest thing is just making sure that you look to see, all right, where does it make sense for me to buy down my interest rate? Because when you buy down your interest rate, there's going to be a cost that's associated at closing.
And I definitely want to dive into some of those rate buy downs, but that actually leads me to the next thing of knowing the difference between a rate and APR. Because a lot of times, like you were saying, oh, just give me the best rate. But that can be padded with a lot of fees or different things that people aren't aware of. So what is the difference between APR? What does it stand for? And what is the difference between a rate and an APR?
Yeah, so your interest rate is actually what that loan is amortized over whatever period of time, whether it's a 15-year or 20-year or 30-year. The APR, annual percentage rate, that's actually all the costs that are associated with that interest rate. Oftentimes when you look at your interest rate versus your APR, it's going to be higher. Now, on a conventional loan product that doesn't have mortgage insurance that has a really high APR, it means that they're padding a whole lot of those costs into the interest rate.
So your APR basically is really exposing more of where those extra costs and fees are coming into play.
Absolutely.
Okay.
Yeah.
That's good.
Now, there is a difference. Like if you're looking at an FHA loan, the APR is going to be higher because you have mortgage insurance on that loan. And so that mortgage insurance is built into the interest rate. So that's one of the things to look for. Like you want to make sure that you're comparing apples to apples, FHA to FHA.
Sure.
But not always having the low interest rate is always the best. Like you might have a conventional product that has a little bit higher interest rate than FHA, but maybe conventional is still a better loan program because of some of those things like mortgage insurance.
Speaking of like how APR can expose more of those fees, what are some of the more common hidden fees that a lender might actually push on someone while they're enticing them with a lower rate?
In this business, we go back and forth, origination fees or discount fees. So sometimes someone will say, all right, I'm not charging you any origination fees, but they're charging you discount fees. Or they might say, we're not charging you any discount fees, we're only charging you origination.
What is the difference between an origination fee and a discount fee?
Well, this is going to get really transparent. Mortgage companies, we make money off of origination. We make money potentially off a discount. Because what we have in this industry, it's basically margin. We have to make money some way. And so it's either origination or make it off the interest rate. If someone gets charged an interest rate of 6%, we're trying to figure out how much money are we going to make off that interest rate over an extended period of time. I might say, all right, I want to make 150 basis points on every transaction. Other mortgage companies might say, I'm going to make 300 basis points on the transaction. And so our interest rates are going to be different because of how much money we have to make on the interest rate. So you as a lender has to, on the back end, decide how much am I willing to either cut back on my profit or make to help make this deal work at that point. So that obviously can be pretty substantial depending on the lender. Mortgage companies try to stay very consistent because we know maybe it costs us 50 basis points to break even. After that 50 basis points, so essentially like on a $100,000 home, we have to make at least $500 to stay profitable or at least break even. Now, if we make 100 basis points, now we've made actually 50 basis points of revenue. So that's why all the different companies, they're all a little bit different. And so that's why it's always a good thing to shop.
Well, that's what we're diving into today.
Yeah.
And so these are different ways in which you're saying that lenders can pad their pockets. The difference between these origination fees and discount points, are there any other major fees buyers or investors should look for?
Compliance required us to make sure that we don't have an invoice and we charge extra for that invoice. Okay, whatever the appraisal fee is, whatever the credit report fee is, whatever verification of employment fees are, those are all the same. We can't charge extra on it. So if you're looking at a loan estimate or a closing disclosure, Section A is where most of that money is made. But what sometimes happens is a mortgage company will throw in extra escrow. They'll say, we're going to collect 14 months of escrow for property taxes. They manipulate those numbers. They don't charge anything on the discount or the origination whenever they initially do a quote. And then they'll actually have the correct escrow account in there. And then they'll add the higher amount for origination and discount.
Oh, shoot.
And it's all the same number, but they've moved things around.
It's all legal, but it's just kind of like fancy accounting.
It's
like,
bait and switch tactics.
what are some of the common bait and switch like scams or quote scams that a lender might give to a buyer or an investor that they really should be trying to identify?
Yeah, and a lot of it's going to take place over the phone. They'll say, you know what, I'll give you 4.99% today. A consumer doesn't know to ask, how much is that costing me? But then whenever they disclose it, most people are in a hurry. They don't pay any attention to it until a lender like me that says, hey, let me see what that loan estimate or the quote looks like. Let's dive into it and see why they're giving you a 4.99% interest rate when the average rate today is, let's say, 5.59. Maybe it costs 200 to 300 basis points, 2% or 3% to get that interest rate. It doesn't really make sense to buy down the interest rate so much because we're in a rate declining environment. You're going to refinance anyways, so why throw all that money into your loan amount when you don't have to?
That makes total sense. So what would you say are some things that you really should always ask a lender before working with them? That way you know this is a legitimate lender, not just trying to pad their pockets.
Man, this is going to get really, again, I would say, what are you making on this transaction? What is your compensation plan?
Just be that up front.
Someone's going to tell you.
And obviously, in a perfect world, the lender makes no money, but you can't stay in business. So what do you think is a reasonable amount of profit for a company to sustain and actually have some growth, but not to a point where they're just being greedy and trying to take advantage of ill knowledge?
I think somewhere like 200 basis points would be a fair amount to make on a transaction, because 200 basis points is going to get split. Like you have expenses, then you have the company's going to make their portion, then the originator, they're going to make their portion as well. Once they start getting upwards to like 300 basis points, they can shave off some of that revenue.
So once you get to 300, it's starting to get pretty aggressive.
Yeah, and there's companies out there that are making 400 basis points
I'm sure.
on a transaction.
That's crazy. So how can you tell if a rate quote is too good to be true?
Yeah, it's too good to be true when you're shopping around and you see the average rate and it's 1 point lower than the average rate across the board. You're going to be paying to get that interest rate. As a mortgage company, at least break even. So if I'm giving myself a deal today, if it's better than that deal that I'm giving myself as the owner of a company, I know it's too good to be true. Someone's paying way too much to get that interest rate. Really, Shaun, it goes back to how much is that interest rate costing you versus how much different in monthly payment. Divide that difference, and that's going to be your break even. If it takes 15 years to break even, it's probably not a good deal. You shouldn't do it. So you'd want to step back on the discount and not pay so much to get that interest rate, because I know there's probably a pretty good chance that I'm going to be able to refinance the next couple of years.
Yeah, I did a refi a couple years ago, and I had to go through that too. Perfect balance of buying your rate down, but also thinking how much am I putting to that, and what is the likelihood of me refinancing again or selling the property, and is it going to make sense to pay those extra fees, or do I just pay the higher amount now and have the option of possibly selling?
Yeah, and I think that's really important to know. What is your game plan? Are you going to be in this house for 2 years, 5 years? Is your goal to sell it because your family is growing? Then you don't want to pay that much in discount points, because it's going to be waste. Like you're out of the house in 2 years, and the break even was 10 years. We just lost all that money.
Yeah, exactly. So what would you say is the one lender scam that actually pisses you off?
Misquoting and then overpromising. And then once they actually get their loan disclosures and they realize if that client is paying attention to what they're signing, that it's not anything that they quoted. And that happens a lot.
It is a fairly complex process, and if you're not extremely knowledgeable on it, I'm sure it's very easy to be taken advantage of.
Yeah, because most of us lenders stay within the confines of the loan programs. Underwriting process isn't different from one mortgage company to the other, unless it's what's called a manual underwrite versus an approved eligible. And a lot of those companies are going to say, well, you know what, I can't do a manual underwrite so you're denied. Just making sure that the lender has a whole bunch of different loan programs just in case you fall outside of that box, that you can be put into another box.
That makes sense. So we've been talking about rates and things to be looking for. The next question is, as a buyer or an investor getting qualified to get the best rates and save you the most money, what makes somebody a A+ borrower versus a C borrower? What matters?
Yeah, once you start getting into that 740 credit score, you don't have to have a huge amount of down payment. But if you have a 5% down payment or a 3% down payment or even a 3.5% down payment and 2 months of savings built aside besides your down payment and your closing cost, that really makes you an A+ borrower. It's a very simple process. Now, whether you're a W-2 employee or a self-employed borrower, it's all the same. Most lenders, when we hear self-employed, we get a little worried. It doesn't necessarily mean that you're not a great borrower if you're self-employed, but oftentimes being self-employed, you're probably going to write off a lot of that income through expenses. What you thought was, let's say $100,000 or $200,000 in income might turn to be only like 25% of that. Luckily, there's a lot of loan programs out there that we can put them into.
Yeah, and being an entrepreneur myself, that does make a difference because I remember some lenders are just like, pretty much just told me no without even seeing my profile.
Yeah, you want to make sure that you protect your credit. And not to say that someone with a 620 credit score is not a good borrower. What I would make sure that if you do have a 620 credit score, you have a lower credit score, even a 580 credit score, you don't have a whole bunch of lates recently. If you can clean up your credit and say, all right, over the last 12 months, I don't have any lates, that's actually a pretty good client. So having no lates on your credit over the last 12 months and making sure that you've been on your job and you're consistently working very consistent hours. So someone that's going sporadically from 40 hours to 30 hours and 25 hours, that potentially is a problem. Now, if you vary and you drop down to 36 hours, that's fine. I'll switch jobs a whole bunch, but if you do, it's okay as long as it's the same line of work. You just don't want to go from a W-2 employee where you're making an hourly rate to a commissioned employee or a 1099 employee. When I hear someone going 1099, I'm like, oh no. Because now you're what's called self-employed. And you've only been self-employed for a month or 2 months or 6 months. You want to make sure that you've had at least 1 year of filing of tax returns. As long as it's the same line of work, it's cool. That's no problem.
Okay, and you're saying that 12 months really is very crucial. Even if you have a history of some late payments, as long as those last 12 months are actually good, that consistency of employment, hours, the most crucial.
Yeah. If someone come to me today and they said, you know what, I want to buy a house and I've got a down payment of 3.5%, but then we pull their credit and there's nothing but lates, you're not technically ready to buy because you need to make sure you're in a more stable position. Even if it's a credit card for a $15 minimum payment, $15 minimum payment is as bad as having a late on a car payment. That's $800. Yeah. It's all the same. Make sure that you keep your credit clean.
So get those payments on time. What would you say is the one thing someone can do to get the best rate? Is it the credit score, the history?
Now we're not doing trended data on the credits. We don't look at the payment history or how someone's actually paying their credit cards. So you can manipulate your credit. Let's say you've got a 600 credit score, but you've maxed out a credit card. You might lose 100 points if you don't have a whole lot of credit. So I would say making sure that your credit card balances are paid down to minimum amounts. Some people say 30%, but if you're trying to capture a whole bunch of points, make sure you're down to a $10 balance. You're going to see maybe somewhere between 15 and 20 points increase in your credit score by having just a $10 balance. Don't do zero because a zero means that you're not necessarily using your credit. So if you have a $10 balance, it means that you're using it, but you're not really abusing that credit card.
What is something that buyers think matters, but actually doesn't when it comes to qualifying?
Huge amount of savings. You do not have to have 20% as a down payment. You don't need 10% or 5%. Oftentimes you can do it with 3 or 3.5 or even 100% financing. So I think the biggest thing is just making sure that you keep your credit in check and you have very little job transfers. Stay on your job. Even if you jump around a little bit, just make sure that you're working consistent hours.
Okay. What's something that you think buyers overlook that actually makes a really big difference?
As a consumer, we don't look at how you pay your utility bills. So most people think that they don't have very good credit. And so they're like, I can't buy a house because I was late on my electric bill. I was late on my car, my cell phone bill, the Comcast bill. We don't care about that stuff.
Oh, interesting. Okay.
And that's why some people say, I just have a 680 credit score, or I feel like my credit is bad. And we pull it and we're like, your credit is great. You can buy a house right now.
Yeah, because there are different credit scores. That's why sometimes you might look on your phone, your app tells you have this credit score, and then your lender pulls it up and you're like, how's that so much different?
Yeah, like sometimes when you have a car dealership pull your credit, like they have different credit score modeling than we have as a mortgage pull. Sometimes like your Credit Karmas and your Nerd Wallets and things of that nature, They're basically trying to put together what a credit pull would look like from a lender. And so that's oftentimes why those companies are like 30 points higher than what we actually pull as a mortgage company.
Interesting. What would you say is the fastest way someone can ruin their loan approval?
The recent late or
Perfect.
incurring new debt
Okay.
or quitting their job, switching to going to a 1099 employment. There's a self-employed borrower now. It happens often when we pull their credit and, hey, there's a new credit pull on your credit inquiry list. Yeah, I got a new car. We got a problem.
We're going to have to start all over again.
You need to get rid of that car. I really like the car.
Yeah.
What do you like more, a house or a car?
So usually the general rule of thumb, if you are starting the loan process and you're in the process, do not buy any car, take on any new debts, no job changes, none of that stuff.
That's
right?
exactly right.
Okay.
Yeah, you don't want to change that financial picture. When we have a debt to income ratio that changes by 0.1%, 0.5%, you could eliminate your approval and it go into what's called a manual underwrite or a FIR underwrite. We might have to back down 10% in your buying power. In situations like that, maybe we pay off a debt. Maybe we get cheaper insurance. The seller concessions to buy down your interest rate because it gives you a little more affordability with a cheaper.
Speaking of different types of loan packages, a lot of people don't know about DSCR loans. It's something that I've actually utilized in the past, especially being self-employed. What is a DSCR loan?
It stands for debt service coverage ratio. Essentially, that mortgage is going to be paid by the rental income. You've got to make a down payment, but we're not looking at your income. We're not looking at your employment. And it's really good, but it can only be an investment property. It can't be a primary residence. It can't be a second home. It's only a business purpose loan. So some would consider it a commercial loan. We can do them. We can do them in pretty much every state, even though we're not licensed on the residential side across the country because it's a commercial loan. But it is a great loan program. For instance, like if you and I, we wanted to start a company today. We start an LLC together. That LLC in a month could buy an investment property with no income, no employment. We could pull our funds together. And let's say you and I, we didn't have a 20% down payment together. You had 10%, I had 10%. We could create this LLC and now we could buy an investment property.
Nice.
And it's great because it's a business purpose loan. It doesn't go on URI's credit. It goes on, it uses the EIN. It doesn't show up on our credit report.
Yeah, you hear a lot of advantages of commercial loans and how you don't have to worry about your credit and it's only attached to the rental income and all the advantages of going commercial. The challenge is that a lot of people can't start off on a commercial property just because they're so much more expensive. So I tell people DSCR is like getting some of the advantages of buying a commercial sized building. So why do you think investors choose DSCR over conventional loans?
You can have 20, 25, 30 properties with a DSCR loan. With Fannie Mae, you're restricted to 10. Once you start getting upwards to that many properties, when you're looking at tax returns, you don't necessarily always qualify when you start getting up to those higher mortgage amounts. DSCR, it doesn't really matter because we don't look at the income. We don't look at the employment of that person. You could continue to accumulate as long as that property is going to continue to cash flow. Some properties, they don't necessarily cash flow, so you've got to make a little bit larger of a down payment. Okay. You go from 15% maybe to 25%. And once you get to that 25%, we don't look at the revenue of that property. Like it's all out the window.
So after you said 25%, you're just like, hey, you're good.
They're making a 25% down payment. That's substantial enough. We don't see any risk in the property.
How does that work for someone maybe with a low credit score in this situation?
It's a loan to value restriction. Okay. So if you had, let's say, a 600 or 620 credit score, you're probably going to have to make at least a 30, 35% down payment because you're a little bit more risk. Someone that has, let's say, a 740 or a 760 credit score and the property cash flows, you can make a 15% down payment. Okay. So the lower the credit score, the higher the interest rate because you look like you might be more financial risk.
What does the lender actually look at when approving a DSCR?
We're looking at credit score, we're looking at down payment, and we're looking to see if that property is going to cash flow.
What ratio is considered healthy?
With a 20% down payment, we wanted to at least pay that mortgage, so a 1-for-1 ratio.
So let's explain that. So what does a 1-for-1 ratio mean? For instance, if, let's say you're buying a multi-unit and your loan's going to be $3,000 a month.
Yeah. You need to have at least $3,000 of revenue that's coming in because it's going to pay that mortgage.
Revenue and not net profit, right?
Correct. Sometimes if you're making a minimal down payment, we want to see more revenue. You might go to 1.25 versus a 1. Some of them might say we're okay with only a 0.8 where it's not covering all of it. But if someone has any worries about the property not having enough revenue, then make a 25% down payment and it's all out the window.
That's awesome. So how do you think DSCR loans have changed investing?
It really gives you more opportunity to buy those short-term rental properties. Fannie Mae does not like short-term rental income. DSCR, that's the type of loan program that loves short-term rental. If you're going to go that direction, do a DSCR. Even if you can prove your income, go DSCR.
Do you think investors should use DSCRs to scale up fast?
I do, but we went through different cycles. So through the pandemic, people had lots of money. Rents were a little bit higher back then. So I'd say that you want to make sure that you're still taking a very analytical approach to it, making sure that property is going to cash flow. And that's the biggest thing, is just making sure that you're cautious about it. Don't scale too fast. Buy a property here, wait 6 months, buy another property in 6 months. So you want to make sure that you research it and just make sure that income is going to be enough to support that. Otherwise, you're going to be funding it out of your pocket.
Yeah, scaling is amazing, but at the same time, you always want to make sure that you are stabilized before you scale. Let's talk about some of the downsides, because like everything, there's advantages and disadvantages. I know you'd mentioned about like the 1-to-1 ratio break even of a DSCR. What would be a downside to that?
It just depends on what you're looking for in an investment property. If you're looking to cash flow from it to fund another project, that could be an issue, especially if you have some vacancies. If you have an area that runs in seasons, I think it's important to make sure that like you have the ability to fund it if you needed to. So a 1-to-1 ratio isn't necessarily the best. So me personally, I like to make sure there's a little bit of cash flow from it. But as investors, we already know, even if you're breaking even, that's a win. Like a majority of what we're looking for is that appreciation gains.
What happens when rents drop and the DSCR collapses? When could DSCR be a bad idea?
It could be a bad idea when we start seeing default on the loans because they're not performing. Anytime you have a loan that's not performing, it's going to go away. Through the pandemic, we had a lot of people that were using it because everyone wanted the short-term rental properties. There are short-term rental properties that are still cash flowing, but it's a little more difficult to see the cash flow.
What is one DSCR horror story that you have?
It just basically it comes down to when people want to make minimal down payments and you can't get it to cash flow. We had this one where it was, all right, we looked at Air DNA. We had the appraiser do comparisons to see what the property was going to cash flow, and it just wouldn't work, and the client wouldn't put any more money down. But it just has to make sense for you as a consumer. Like if you're taking away money from your savings to make a deal work, and it leaves you in a tight spot, it's not a good position to be in.
Yeah, that's one thing I tell people all the time. Everybody wants to own rentals and get that passive income to build wealth. But I tell people, if you're already living paycheck to paycheck and you're someone who doesn't make a lot of money, excess savings every month, if you save up all this money, but that takes your entire account out, if 4 months later something, the water heater or the HVAC goes out or something, it's very easy in real estate to get stuck with like multiple 5-figure, $10,000, $20,000 bills in real estate. I just spent 20, 30 grand just last few months just renovating some of my places, and you got to have some money behind you because real estate can be expensive.
Yeah, it really can. If you're not ready for that, then you're probably not ready to invest.
Yeah.
And I have a lot of clients here recently. They're like, can I make a 10% down payment? You can't, not yet. We don't have those loan programs out there just yet. But there are some fix and flips that you can use if you wanted to get in there and you wanted to do a 10%. But you've got to have an exit strategy to get out of it. Whether you refinance it because you want to put it into a long-term investment or you're going to sell it. You got to have some money set aside.
Yeah, for sure. You just mentioned about downturns or seasonality, markets changing. I want to dive into market cycles because a lot of people have been feeling some market cycle changes, especially from a few years ago when it just seemed like people would buy a house and then literally sell it a week later at a profit. Real estate has been pretty flat and actually been declining a little bit, depending what area of the country you're in. Why do you think that is?
I think it's a buildup because humans forget about the past. And so we remember all those things like the low interest rates. Sellers, they remember how quickly things were moving off the shelf. They're like, why would my property not sell quickly? Because it did in 20 and 21. And then the interest rates, 2% interest rates and 3% interest rates. And even before that, we still had really good interest rates because we had the biggest housing crisis of all time. So for us to have gotten into the 8% interest rate range, and I was not going to give someone 8%, but the market, it did have some 8% interest rates out there for a period of time, like in 2023. If you go back 83 years, 84 years, we've had appreciation almost every year except for 5 of those years. And so I think, but it's hard for people to understand.
Are you talking nationwide or just
nationwide?
Tennessee? Okay, yeah.
Yeah, that's nationwide. Yeah, and within the country though, you're going to have different markets, like your California market versus your Tennessee or even your Northeast markets. Those Northeast markets are actually...
They're still pretty good.
They're good. They're actually really good. You got to understand that all the markets are different. And that's why it's really important to speak to an expert like yourself and myself that can explain some of these things and really break it down to have a better understanding. But I think the market has been flat for a lot of reasons. Ultimately, we remember the past and we can't get past it. Now, we give it a couple more years and Actually, it's a normal market right now.
Yeah.
People don't understand it.
This
is a normal market.
Exactly. I think we're all used to such a strong bull market, but it's like we're actually in a pretty neutral market and economy right now.
Most areas have between 3 and 4 months of supply, some 6 months supply. That's a buyer's market. Where we are right now, it's actually, like you said, it's a very balanced market. Interest rates are actually fabulous right now.
Yeah.
Because if you go back 50 years, 60 years, you're almost at 7.6%. We're in the mid fives today, low fives today on government programs.
Go back to the Carter era where you're getting like 15 to 18+%. It's like you're buying your house on a credit card. You know what I mean?
Well, it was back in 82? It was October 7 of 1982. Interest rate got to 18.6%.
Yeah.
18.7%.
So would you say that rates are currently going up, staying, or going down? I know this is like the question you get all the time. Hey, when are the rates going down?
Yeah. There's a lot of talk that the 10-year will get down to 3.67, There's a retracement line that follows kind of like that number. If that happens, and margin will compress just a little bit, but we'll likely see somewhere around that 5%, maybe upper 4s. But I think for a lot of consumers, they think that they're going to jump into the market when they see a 3% interest rate. It's not going to happen. We have too much debt in the country. And so we're going to continue to do IOUs. And if they don't buy it, the interest rates are going to stay high. Every time that the Fed gets involved and they do what's called quantitative easing, that's when interest rates really drop.
I just posted a video on this. If you read the headlines right now, everybody's, oh my gosh, everything's going to crash and go to zero. If you look at the macro indicators just don't really show it. There is a $10 trillion liquidity event that's probably going to happen over the next 12 months. The Feds have to refinance their $10 trillion debt. And when they do that, they have to do that by putting more money into the system. And typically they're going to want to refinance at lower rates. So they're going to start dropping rates.
Yeah. And they're putting money into short-term bonds instead of the long-term. And that's when like your ARM products start to get really good.
Sure.
And through the last couple of years, ARM products weren't great at all because there was an inversion in the bond prices. The 10-year were actually better yields than something on a 2 or a 5-year. Right now we're seeing ARM products that are in the 4s, like 4.699 on a 5-year ARM, which is great.
You did mention something I wanted to dive into, even though the rates are good, but still high compared to what we're used to a few years ago. When I talk to people and they ask me, is it a good time to buy? I actually tell people, actually, it's the best time to buy when rates are high, because that's usually when there's not a lot of competition of buyers because everybody's scared. You can negotiate the best terms to get the best deal. And then as rates come down, that's when asset prices start to go up. What are your thoughts?
100%. We should have been buying yesterday, but today's the next best day to buy. Higher rates are a buyer's best friend. You have all these other buyers that are sitting on the fence. You need to be buying right now. If all of the entire population says to do this, you probably need to be doing opposite of what they're doing. You're spot on. You need to be buying right now versus waiting for that really ideal rate. As you have a 1% interest rate drop, you have 5 million more buyers that are eligible to purchase. Not all 5 million will jump into the market, but that just means that it's going to push up the prices because you only have so much inventory. You're not going to get the concessions from the seller. There's probably going to be some bid over ask stuff that takes place. And you would have wished that, man, I should have bought that property when it was $20,000 cheaper. With the higher interest rate, you got to get past like where the interest rates are now. When they drop, refinance.
I hear so many people like, I just wait till the rates go down. It's like prices are going to start going up. You have the buyer pool, competition. You're probably going to pay more. There's been a lot of stuff going out in the news lately about the talks of possibly a 50-year loan that Trump announced. I actually posted a video recently on it, but I want to get your take on whether you thought that would actually be helpful or hurtful for long-term buyers.
Through the appreciation gains in 20 and 21, it outpaced wage growth. So now you have someone that makes $50,000, $60,000 a year. They can no longer afford to buy a $325,000 home, $350,000 home. Now that you have maybe a longer amortization, that person that makes that amount of money can still purchase that home and still make ends meet. If I asked you, Shaun, do you plan on paying your particular house off? What would you say?
Absolutely not.
Most wouldn't. No one keeps their mortgage for 50 years or 30 years or 20 years.
I think the average homeowner holds their house for about 11.8 years, like nationwide.
That's their home, but not their mortgage. Most are actually refinancing. I think the number now, it's probably changed just a little bit, but as 3.7 years. If you're changing it that quickly, you're probably not going to pay a whole lot of principal down.
Even in a 30-year loan, the first about 10 to 15 years is pretty much all interest that you're paying. It's very little debt pay down.
Except for the appreciation gains. That's the one thing. And I think for that reason, when I bought my first house, I had no plans on paying that house off. But when I sold it 3 years later for $275,000, I made $150,000 on appreciation gain. I could never have made that amount of money. For those reasons, I would say I think it could be a very good thing.
I think the biggest things I hear, you're going to pay like over 3 times your home. You buy a $500,000 home, you're paying $1.15 million total. Yeah. If you were to buy the home today and literally pay every year for 50 years, yes, most people are not going to live in a house for 50 years. They barely make it to 11 years. But like you said, you get the appreciation growth and the wealth build. There will definitely be a bulk of people who end up buying possibly more home than they need. And that's probably going to hurt them. But I do think the 50-year could be really phenomenal, especially for like disciplined investors. If I could save $300 or $400 a month by going to 50 year instead of 30, and then I take that $300 a month and I put it in, let's just say like the S&P 500 and earn 10% a year. When I ran the numbers, you literally come out millions of dollars ahead in net worth. But of course we know most people unfortunately are not that disciplined, and it's going to go to more vacations, eating out, clothes.
Yeah. I think you just have to be really dedicated to whatever plan you go. Make sure you stay consistent with it. Don't divert from that plan.
Yeah, 100%. So what would be one bold prediction about the housing market most people wouldn't believe?
Think that we're going to have a strong 2026, and I think we'll have upward to a 5% appreciation.
Okay.
Homes are not going to go down in value. We're actually going to have closer to about a 5% appreciation.
Yeah, I just looking at like macro cycles, I think we've pretty much reached the bottom. If you follow the trends, that 12, 24 month lag from liquidity, that should put us in 2026 going into 2027. It should start seeing some really good, I think, real estate growth. That's what I'm expecting.
And I think we'll have some Fed rate cuts. December is still... It's still up in the air. There's a 65% chance that we have a Fed rate cut in December, but that's the Fed fund rate. That's the short-term debt versus actual mortgage-backed securities.
Yeah, because just because the Fed's cut rate doesn't mean that right away that like mortgage rates go down, right?
No, it doesn't work that way at all because the mortgages are not tied anywhere near to the Fed fund rate. And when you hear about the Fed rate cut, they're cutting the Fed fund rate, which is the money that they loan out to banks and banks to other banks. Installment loans, your credit cards, even HELOCs, sometimes those are tied with it. Those are the ones that are directly impacted quickly. Mm-hmm. Now, will a bank give you those savings? And sometimes they don't pass all those savings on to consumers because they want to maybe have a little bit more margin in the market. But ultimately, though, when you have a Fed rate cut, interest rates on mortgages get worse. Typically, what happens is the interest rates of the mortgages will get good leading up to it. And then the Fed, after every meeting, they'll talk about what they spoke about in their meeting. And if they say something that the markets do not like, then you'll have a sell-off. Now, if they talk, and they don't ever talk this way, but they're like, you know what? We see a whole bunch of rate cuts coming up in the future. Then like the mortgage-backed securities investors will be like, all right, let's go jump in and let's buy some securities. Then you'd have some improvements in mortgages. But ultimately, I think that we're going to continue to see rate cuts for two reasons. I think inflation is coming down a little bit, but again, you talk about lag effect. There's lag effect, and I don't think our inflation calculations are all that great because they're talking about, let's say an average consumer, let's ask them how much they're going to rent their house for.
Yeah.
They don't know. I'm in the business and I hardly know what I'd rent my house for. And you have 38% of your CPI is owner's equivalent rent. And so you have a consumer saying, all right, this is what I'm going to rent it for. And that's part of your inflation calculations.
Yeah, when Feds are like, oh, inflation's here, it's like you can manipulate that. What pocket of assets and consumer goods are you putting in this like pool? Because like it's so variable. I really honestly just let that go in one ear, one out the other.
The thing though that is going to be something to pay attention to is unemployment rate. This is going to be one of the true indicators of if the Fed continues to cut rates. What is the job market doing? If it continues to weaken, we're going to continue to see good rate cuts. They don't want to hurt the job market.
There's
too much risk.
Affordability factor too. Yeah, for sure.
Yeah.
No, that's very interesting. Let's dive into you a little bit. How'd you even get started in lending? Growing up as like a 5-year-old kid where you're like, man, I cannot wait to be a lender.
I saw myself at a young boy being a loan originator. You
know,
I was like, no, I didn't. Actually, I had an entrepreneur spirit whenever I was growing up. My dad, he owned a company. It was an art company. And I thought, I'm going to own a company at some point in time in my career. Growing up, I didn't know what it was, but at 12, I was like, I'm going to do something. Cassie and I, my wife, we started a date. Her dad was in real estate. I love finances. Like I love to make money. I was working at a very young age. I was working at 7. Like I was doing.
Dang,
I was working at a young age. I was hustling the neighborhood. Hustling the streets at school, selling candy, making bracelets and stuff like that.
I used to sell study guides in middle school. I'd make these like elaborate study guides and I started selling them off for like big exams and stuff.
Some shady stuff. And anyways, Cassie's dad he was a real estate investor, did real estate. And I don't know if you remember a guy named Carlton Sheets, but it was like how to be creative with financing.
The name sounds familiar, yeah.
And so it combined like real estate with financing. And I was like, all right, that's pretty cool. So
Yeah.
I got I was big on these commercials. And I was like, man, how do I get rich quick at a young age? I was like doing all this studying. And I went to school. I was like, okay, I did want to be a doctor at one point in time, but I realized that it was like 12 years of schooling.
That's what I went to college for originally. I was like,
no way, can't do this. And I graduated as a staff accountant because I love finances. I love real estate. Accounting was not my thing. Like, that was not my thing.
Yeah.
And Cassie's cousin she was originator too.
Oh, okay.
I was like, all right, she's doing well. And I think I like it. Between financing and real estate, this could be a good fit. I did it for about a year and a half, 2 years, but a year in, I was like, I'm going to do this. This is going to be the company that I own.
And how old were you?
I was 24.
Okay.
So 25, we actually became licensed. I bought a building, did it upright. We were doing really well, but it was obviously a lot smaller, and just loved it, man. I had passion for real estate, passion for helping people at a young age. You always look as a kid, even growing up, you're like, what was my path? What is it meant to be? Right. I feel like this is the career I was meant to be in.
That's awesome. Yeah. And I talk a lot about entrepreneurship. I feel like today, entrepreneurship is like extremely glorified. And there are definitely some amazing parts of entrepreneurship, but it's a freaking grind. It's a hustle. What would you think was the hardest part for you early on?
I think there's just no map how to do it. In school, you go through these different classes. Yes, some of it's applicable, but it really doesn't convey exactly how to actually run a successful business. That was the hardest thing, is there's no guide how to do it. You're like putting all these pieces together. I don't know if this is going to work. And so you do it. Hopefully it works. You're always changing. And I think that's the biggest thing, is just making sure that you're always nimble and you can make changes.
Yeah, I have this idea. Is be married to the dream, but flexible on the path. There's no playbook. Entrepreneurship is literally like an open field. Yeah.
And just realize you're going to have some lonely nights.
So that's exactly what I was getting ready to ask you next. You start off your company. It's probably just you and your wife, right? This is really hard for most people. Being an entrepreneur and a solopreneur, you're not doing this by yourself anymore. You have a whole team. How do you go from solopreneur to number one in the state?
Yeah, I think the biggest thing is just making sure that you had a good process, good products, good people, and then building it out so that we could just plug in people. Once we were able to just really figure out what I do best, I like the relationship side of things. I know the industry really well. Once you have a good product and you have a good process and you know where you can plug people in and train them up, it's pretty easy.
So it's just basically like doubling down on your biggest skill sets and assets, and then leveraging other things. If you know that doing this brings you $100 an hour, and then doing some admin inputting, you can hire that for $15 or $20 an hour. You ask yourself, like, what do I want to value my time at? And if you aren't willing to work for that amount per hour and you can hire it out, then you hire it out.
I think that's exactly right. And some people say, I don't want to spend money on that because I can do it myself. You're going to have to invest in your people, invest in the company. Spend more money on marketing that you've ever spent. You just got to be willing to reinvest back into your company.
And that, I think, is the single biggest inhibitor for scaling. They finally get some momentum and they either quit their job too early and now they need every single dollar the business is making to uphold their lifestyle. Or even if they are making a decent amount in their business, once again, they're not putting that money back to reinvest. And what happens is you get stuck in solopreneur.
No, I agree with you all the way. Like, it's difficult to balance it all out, but I think it's really important. You've got to know where your money is, like, in time is best spent. And marketing is one of those things that most people don't spend enough money on.
Out of sight, out of mind. So
yep.
What is it that you think that you did differently that has allowed you to scale and become successful?
We weren't necessarily worried about making a profit on every deal. Like, we were just worried about making sure that we took care of our people, take care of our clients. And it came back full circle. Because we were taking care of our people and our clients, people wanted to use us. Yeah. And it wasn't necessarily chasing the dollar, it was helping the relationship. There are times where we make no money. My people come to me and like, hey, you didn't make any money on these. What's going on? That's marketing to us. Because we're taking care of our clients, they're going to tell their friends, their family, church members. It's going to come full circle. But you can't expect always to have that huge amount of profit on every transaction. And it's kind of like your philosophy. And that's kind of like what we're doing now, is the more business that we bring in, we've got to make sure that we have all the people that can fill all those different spots. Behind the scenes, the loan partners and the processors and the closers and things, we've already got it all built out. All we got to do is add people. Everyone within our company pretty much had no knowledge of mortgages. They couldn't even spell mortgage. We trained them up, and we've got a really good trainer. It's important to make sure that it's consistent. Our recipe is the same. Like, our process is the same every transaction that we do. Once you create your foundation, you've got to stick to it. You know, you might change some things here and there and continue to make it better. And don't get complacent.
As soon as you get comfortable, something changes, whether it's the economy or the way the whole industry works. So this whole process of entrepreneurship for you, starting so small and then building this up, what do you think was the biggest lesson that you learned?
To delegate. If I would have delegated earlier, we would have built it. But honestly, I think there's this path that we go through, and I just don't know if I would really change anything about it, because like, you learn so much from your failures to put you in a position where you can actually achieve better later on in life. Failed a whole lot, but I feel like we're in a good spot. But really, I think it's be willing to delegate and take yourself out of the business a little bit sooner and work on your business.
Was there a moment that you realized that this business was going to be as big as it was as this day and probably will be in the future? Yeah.
I think as long as you put it out there and you hold yourself accountable, you can really do anything. We want to continue to help more and more people in all of Middle Tennessee and other states as well. Like, I love building our team. First, you start as an employee, then you become a team member, and then you become a family member. We just want to continue to help people.
Was there ever a time when you realized, like, this isn't just a vision now? I know for sure that this is working.
Yeah. We continue to grow and seeing success like in the late, like 2018, 2019. It's like, okay, this is pretty good. Even where we are now, I want to continue to get better. You want to continue to innovate. We have some really good partners out there that really, they support us. I was up at UWM this last week. That's the biggest company, mortgage company, lender in the entire country. They give us a great example how to be successful. We have some really good mentors. I'm grateful for those opportunities. You see the success, but you can't get so embedded in that to think that tomorrow is going to be the same. We want to continue to build on it.
Entrepreneurship is insanely challenging. It's a grind. What do you think separates high performers?
Consistency. I'm going to be consistent each and every day. I might feel like crap that day, but I'm going to continue to show up every day. This isn't a sprint. It's a marathon, and the marathon is day after day after day. And as long as someone puts in that effort and they hold themselves accountable to it, like, you're going to be successful.
Yeah. It's just crazy how, like, the smallest efforts compound over time.
You can relax a little bit, but maybe it's only a day. You can't take off a week.
Someone else is gunning for you.
Someone's coming after you. But I want to be the best person I could be. Like, I want to continue to improve as a leader, as an originator, as a father, as a husband. We're never too old to continue to learn. I've probably done the most reading in my entire life in the last 3 years. If we have that mentality, you're going to be successful from it.
The reason behind what you do changes and evolves. And fitness, honestly, the main reason I got into fitness was very superficial reasons. And then it became who I've become, like, in this whole process, the dedication and the persistence and the discipline. It's changed me as a person. And then you start realizing, if I can do this, like, what else can I do? And then as I got married and had kids, and it becomes like, how can I build something for my family and helping others? That fuel is so much more powerful than the superficial stuff.
At a young age, I wanted to be rich, maybe even my 20s, but then it changes. And there's been different times in my life, like even now, I'm like, why not? Why not do more?
Yeah. I got so much more fulfillment and satisfaction out of someone who acknowledged me in one of their books and just talked about how I changed their life. From that, then the money I got from them as a client, there's so much more that you can do and the impact that you can have.
I agree. I've got this nice car now, and then like, okay, that wears off. The feeling of helping, like, someone that never thought that they could buy a house, like, that chokes me up. Even today, like, I'll go to a closing and I'm like, wow, that's why we do what we do. Helping people, that's what's most important.
I had a client a few years ago that she was a single mom and she had 4 or 5 kids and really did not think home ownership was going to be a thing for her. I worked with her for almost a year, everything from fitness to wealth building. And she actually ended up getting qualified for a loan. And I remember talking to her and she was just like, I would have never in my life thought that I was going to be able to actually get a home one day. And the person that she transformed into, that for me is so meaningful.
Yeah. Having your own place. Like, it's really important.
Yeah.
And from the outside looking in, oh, it's just a house. No, it's your home. People take a lot of pride in their home. They say that 90% of the millionaires out there, it's from real estate.
One of the things that helped you guys scale was that delegation and learning how to utilize other people. So what do you think entrepreneurs focus on too much that actually probably hurts them?
Working in the business just too much. So taking it from start all the way to finish. Now we have an assembly line. I'm going to do an application, and then I'm going to have a consulting with the client. And then behind the scenes, we have a really good team member that's probably better than I am at reviewing documents. Then we have someone that's very analytical that's doing another part of the process. I think oftentimes that entrepreneur is doing everything from start to finish. Maybe they're doing their own marketing. Maybe they're doing the actual repairs on like an HVAC unit. They're doing the billing and then the paperwork. You can only do so much business. When you scale it out though, and you have all these people, yes, you're going to have to spend some money hiring some additional people, but you can do a lot more business. You can actually have a little bit of life balance.
And you truly can't be the best at everything. You pick the one thing that you are really good at, double down, leverage out the rest, and become irreplaceable in that one thing. What would be one piece of business advice that you would give to your younger self?
Be uncomfortable quicker. I need to put myself in a more uncomfortable position earlier.
What would you think is the biggest myth about success?
Money doesn't bring you happiness.
If you're not happy and you are chasing money to solve it, when you finally get it, you're going to be severely disappointed and probably even more unhappy than you were before. But if you're moving with drive and passion and purpose, and it's not necessarily about the money, then it really becomes a magnifier of outreach and satisfaction. And
yeah, you got to have your why. For me, it really is, I want to help people. I want to give opportunities to even team members, but ultimately we do it for our families. That's my why.
Okay, so we're going to do just a very quick rapid fire. Biggest myth in lending.
That's a hard one, Shaun. Biggest myth in lending is tomorrow's a better day to purchase, to buy. Buy when rates are low.
Yeah. Worst mistake home buyers make.
Waiting for their mind the right time to purchase.
Worst mistake investors make.
Not doing the research.
Most underrated factor in qualifying for a loan.
Credit score.
Best advice for first-time buyers.
Don't wait to save up for the down payment.
Best advice for entrepreneurs.
Be uncomfortable.
Something you believe that most people disagree with.
Leverage a mortgage.
Best financial decision you've ever made.
Buying real estate.
Where can people find Kevin and Lending Hand?
Yeah, it's pretty simple. LHMTG.com, 859-LEND. Actually, it's 615-859-LEND. Pretty easy. I'm the only Kevin Kenerson that's out there on social media. We're the only Lending Hand Mortgage here in Tennessee. And we would love to help out any way that we possibly can, even if it's like just doing the consulting and answering questions. But it's got to be it's got to be right for you. Yeah. So many people are waiting to buy a house because they think it has to be perfect. You're going to be paying rent somewhere.
Yeah.
And so many people, they don't want to give up some of the things that are comfortable. Sometimes you have to give up some of those things to buy a home. And ultimately, you got to suffer a little bit to have a little success later on in life. It's worth the sacrifices to put yourself ahead.
Hey, man, it was so awesome chatting with you and learning so much about the mortgage industry process.
Thanks, Shaun.